Hello, everyone, and welcome back to Accounting with Oscar. Now, just as I promised, here is another Accounting Paper 1 video discussion for all of you. So, today we're going to be discussing another new paper, right? So, this is the Accounting Paper 1 multiple choice paper from the May-June 2025 series. Now, this is variant 1 out of variant 3. This paper, if you analyze through the questions, in fact, if you analyze through the May-June 2025 paper 1 accounting papers, whether it's variant 1, 2, or 3, you'd see that the papers are relatively easy this round, right? I mean, I've had a look into each paper. The difficulty level of paper 1 for this May-June 2025 sitting was not very high. In fact, it's very much doable, it's very much attemptable. I mean, when you compare it with paper 2, obviously there are some tricks here and there in paper 2, but paper 1 is fairly straightforward. Alright, so let's begin our discussion today. So you can pause this video, continue on with your questions, come and check your answers, or you can just use this as a study with me, do the questions together as I go, right? Well, obviously without a cat next to me. So all right, let's look at question 1. Now, which task will not be performed by a bookkeeper? So this question tests your understanding on the difference between a bookkeeper versus an accountant, right? So you need to have some theoretical knowledge here. A bookkeeper, usually what they'll do is they will record and summarize transactions. So they are the ones who perform all your data entries. They are the ones who bring everything into the journals, the ledgers, and just sorting out all your filing and everything. So that's more of a bookkeeper. Now, if you're looking into the role of an accountant, they are more towards the final processes. So what they do is they will prepare financial statements, right? Accountants will prepare financial statements after everything else has been drawn up by the bookkeeper. So just a quick revision. We always start from documents, right? We summarize the information in the documents into what we call the books of prime entry or the journals. From the journals, we bring over the total into our T accounts, the ledgers. From there, the trial balance is drawn up. And finally, we come out with the financial statements, right? So from here, the income statement and the financial position is drawn up. So everything that you see in red, right, everything up to the point of the trial balance would be done by a bookkeeper. So the accountant will focus on preparing the income statement as well as the financial position. So with the financial statements, the accountant can do a little bit more, right? Besides preparing financial statements, they will also help to analyze the financial statements to see how the business is performing. Now, when you talk about analyzing, one of the ways that we do it is actually through the use of ratios. So the accountant will also calculate accounting ratios, and there is your first answer. So bookkeeper, they will prepare the purchases journal, they will prepare the sales journal, they do write up the petty cash book, but they do not calculate any accounting ratios, right? Accounting ratios are part of the analysis. Analysis would be carried out by the accountant. Now let's bring you on to question 2. Question 2 is a very easy question. So it's a short one, in fact, right? What are assets? That's it, 3 words. The 3 words, every lady wants to hear. What are assets? Yeah, so what are assets? Okay, assets are things, right, which belong to the business, items owned by a business, right, which the business has control over. So let's go through each column. Amounts owed to a business, right? Somebody owes the business money. Now, this is something that belongs to us. We have the rights to get our money back. So, yes, this is by definition an asset. Now, the second column, you have amounts owed by a business, owing by a business, right? Business owes money. This is not an asset. In fact, this is a liability. So the answer is no by definition, right? Items owned by a business, right? You have ownership over this item. Yes, that is an asset. So the correct answer would be C. Any amounts owed to a business and the items owned by a business would be classified as assets. Okay, let's bring you on to question number 3. Sammy bought goods on credit and later returned some of these goods. How would he record the returns in his books of account? So they want you to work out the double entry for a return. But of course, it's not going to be that straightforward, right? First, you have to identify which type of return is this. Is this a sales return or a purchaser's return? Well, either way, I think your examiner is being very nice here. They've given you all purchaser's returns, right? It's all purchaser's returns. They are being nice, I would throw in some sales return, or just throw in some return in outwards, confuse people. I mean, we like to see the world end. Okay, well, anyways, so this is in fact a purchase return because you bought, right? You purchased the goods on credit and you return them to the supplier. So it is a purchase return. So what's the double entry for a purchase return? Purchases, they are a part of our costs. They appear on the debit side. So when you are going to reduce the amount of purchases, we are going to park it to the opposite. So I'm going to park purchases return on the credit side. So it's a reduction to my costs. And I shall debit the payables or the supplier account. So usually the supplier or the payables, they are a liability. Liabilities appear on the credit side. So when you reduce the amount of liability, we'll park it to the debit side. Alright, so it's a debit to supplier, credit to purchaser's return, because you are you're reducing both your liability and also your costs. Okay, now let's bring you to question 4. An account in Peter's books of account was as follow. So we have the account of Rami here. So Rami has a balance brought down on the credit side. All right, so this is safe to assume Rami is a liability, right? Which is a payable. Safe to assume, okay, balance brought down on the credit side, liability. Safe to assume that he or she is a payable. Yeah, I'm not gonna like gender type people nowadays. It's neutral. You don't know if Rami is a male or female. Could be both. So you have bank 380 on the debit side. So this here reduces the liability. So the bank would reflect a payment payment to Rami. And the discount received is the discount that we receive for paying his account early. All right. So let's hope you remember this. In accounting, we have two types of discounts. We have trade discounts and we have cash discounts. So trade discounts is the discount that you give people, right, if they purchase in bulk in large quantities, or if you are in the same trade, right, the same industries, then you would offer them a trade discount. But the thing about trade discounts is that they never appear in the ledgers. All right, so that's a note to take note. Trade discounts, note to take note. Yeah, good job, Oscar. Good vocabulary. So trade discounts, right? They never appear in the ledgers because they are always accounted for within the invoices. Whenever a customer comes and buys something, right, we just need to look at the quantity they are buying, or you just have to look at their face and you know if this person qualifies for a trade discount. That's why it never appears in the ledgers. It will always be deducted when you prepare an invoice because you would know straight away if this person qualifies. But cash discount is a little bit different. Cash discount is what you are giving people or what you receive for early settlement or early payment of an account. Say your credit period is 30 days, right? And you pay within like 14. So most people would give you a certain amount of discount just for paying early because it helps their cash flow. Now, this will be separately shown in the ledger, which is this item right here, this $20. Because at the point of sale, you never know if this person is going to pay you early. You can't make an assumption that because he wears a suit and tie, he'll pay early. Yeah, we can't do that. All right, so sometimes they pay early, sometimes they don't. We don't know. So we don't do anything to the invoice. We will give them a discount as they pay us. So it's a separate item within our ledgers. So Peter received a discount for buying in bulk. That's false. All right, this is a trade discount. Doesn't appear in the ledger. Peter received a discount for paying early. Yep, I think this is a good answer. Steve Harvey would agree. Rami received a discount. No, we are not. We are not Rami, right? We are Peter. Peter, right? We are Peter. We are dealing with Rami. We're not Rami, right? So Rami doesn't receive any discount. Rami is the one giving the discount. Question number 5. At the end of her financial year, Jasmine balanced her cash book and ledger accounts and made appropriate year-end transfers. So which statements are correct? Let's read through it one by one. The debit balance of an account, debit balance on the account of a credit customer will be shown as an asset in the statement of financial position. Is that correct? A debit balance on the account of a credit customer, which is our receivable, will be shown as an asset. Yeah, I think it's a good statement, right? Receivables, they owe us money. So we have the rights to the payment. It's an asset. Number 2, the debit balance on the bank column in the cash book will be shown as a liability in the statement of financial position. So bank account, debit balance, you do have money, the money does belong to you. It should be an asset, right? It's in no way a liability. Liability would have to be a credit balance. Number 3, the total of the discount received account will be included in the cost of sales in the income statement. So discount received account, right? These are all cash discounts. So are you going to include cash discounts in the cost of sales? No, we do not, right? Only trade discounts will be affected. So answer should be obvious, but we're going to check out number 4 just in case. The total of the general expenses account will be deducted from gross profit in the income statement. Is that a correct statement? So you have sales less cost of sales to get gross profit. So from gross profit, what are you going to do? From gross profit, we are going to add in all our other income and we'll take out all the expenses, which general expenses do fall under. And from there, we get our profit for the year. So safe to say number 4 is a correct statement. So your answer would be C, 1 and 4. Question 6. A trader bought goods on credit from a supplier. In which book of prime entry or in which journal would the trader record this transaction? Very easy, level 1 question. Bought goods on credit, these are credit purchases. So credit purchases would go into your purchases journal. The cash book, you will see all the cash and bank transactions, right? Sales journal, you're going to record all credit sales, right? And the general journal will be used to record any other transactions which do not fall into the other books of prime entry. Right, let's bring you to question 7. Which account balance will appear in the debit column of a trial balance? Again, level 1 question, very easy. So, debit column of the trial balance, we only have 2 items, right? So either it is going to be an asset or it is going to be an expense. These are the only two items appearing on the debit side. Carriage inwards. So for those of you who do not know, carriage reflects delivery, right? There are two types of carriages. We have carriage in and carriage out. So carriage in is the delivery incurred to deliver the goods from the supplier to you. Alright, supplier delivers to you, that's a carriage inwards. Carriage out would be delivery incurred by you to the customer. Right? One is coming into the shop, one is going out of the shop. So either way, carriage will be an expense. Alright, so carriage inwards would be your answer. Discounts received is an income. Income is on the credit side. Provision for doubtful debts is a reduction to asset, will be on the credit side. Purchaser's return is a reduction to your costs. It's going to be on the credit side. Question number 8. The totals of a trial balance did not agree, and a suspense account was opened. It was later found that the total of the discount allowed column in the cash book of $100 had been credited to the discount allowed account. So which journal entry corrects the error? Right, so we've done something wrong here. It was a discount allowed. So by default, discount allowed is an expense, right? You're giving a discount. So this 100 should have been on the debit side, but it was credited to the discount allowed account. So it's supposed to be on the debit, but we have parked it on the credit side. So as usual, I'm going to come out with my 3 columns to help to make things easier. Your double entry should have been to debit discount allowed, credit the receivables, right? This is what you should have done. But what did you do? Right? You've done something wrong. You credited discount allowed instead. So there are going to be 2 credits in your transaction. So to perform correction of error, I always have my 2 steps to work with. The first step, we are going to reverse the wrong entry. Whatever we've done wrong, we're going to apologize and we are going to record the correct entry. Reverse the wrong entry, record the correct entry. So what I'll do is I'll reverse this credit. Sorry, that was the wrong one. I'm going to reverse, right, this credit to discount allowed. So reverse the wrong transaction, record the correct transaction. So I will debit discount allowed to reverse the wrong entry, and I will debit discount allowed again to record the correct entry. So debit discount allowed 200, credit suspense 200, because you have double credits. So we need to make use of the suspense account, right? Trial balance doesn't tally. Are we good? If we are, let's bring you on to question number 9. After calculating his profit for the year, Yui discovered the following errors. Number one, a purchase of a new motor vehicle for 3,200 was debited to motor expenses. Okay, something's wrong. Number two, the purchaser's account was overcast or overstated by 500. So, what was the effect on the profit for the year after correcting these errors? Ignore depreciation. So, let's look at the first one. The first one, you purchased a new vehicle, right? So, it is supposed to be an asset, but we recorded this to motor expenses. Now, bonus points, you can tell me what error occurred here. So this is actually an error of principal, right? So you went into the wrong account of the wrong category. It was supposed to be an asset, but you recorded expenses. So when you correct this error, your profit will eventually increase by 3,002 because you're removing the expense away. Purchaser's account was overcast by 500, so your cost was too high. When you correct this, we need to reduce the purchaser's account. So when you reduce the purchaser's account, your profit is going to go up. So in total, the profit would have increased by 3,700. That is the effect on profit. Question 10. Jerry received a check of 450 from Fatima. He entered the receipt of the check correctly in his cash book. The posting to Fatima's account was reversed in error. So which journal entry corrects this error, right? Correction of error, 3 steps, right? The three columns, I'm going to call them. So when you receive a check from Fatima, your correct double entry should be to debit bank 450 because asset increases, and will credit Fatima's account by 450 to reflect the reduction in receivables. So this should have been the correct entry. What have we done wrong? So we did not make any mistake on the bank. So we did a debit 450. This is correct. But instead of crediting to Fatima, we reverse the entry. So we actually debited Fatima's account by 450. So you can see, similar to the previous question, we actually have double debits. So when there's a double debit, the trial balance will not agree. Right? Trial balance doesn't agree, doesn't tally. So we need to make use of a suspense account. So once again, I'm going to come up with the 2 steps. We are first going to reverse the wrong entry, and after which we are going to record the correct entry. So here, my step 1, I'm going to reverse the debit to Fatima, and step 2, I'm going to record the credit to Fatima. So in total, I will credit her account by 900, and the corresponding entry goes to the suspense account. Debit suspense, credit Fatima's account. So that would be the correction of error. Now, if we're good, let's move on to question 11. Rogers' bank statement showed a credit balance of 740 at 31st January. Somraj compared the bank statement to his cash book and updated the cash book after he found the following. So there are bank charges not recorded in the cash book, checks paid but not presented to the bank, right? Unpresented checks 150. So what was the updated cash book balance at 31st January? So this question here is a little bit tricky. It's not as straightforward as the previous 10 questions we have seen. So this one is slightly tougher, right? But I won't consider it a level 3 question. At most, it's a level 2. So it's a bank reconciliation. First, we need to understand that the credit balance on the bank statement actually represents a positive cash balance. I know most people see credit, you think of overdraft, but here you need to be careful because you're looking at the point of view of the bank. Right? So a credit balance on the bank statement is a positive balance. So you start from 740, this is the balance per bank statement, and you're going to reconcile to the balance per cash book. Now, since you're starting with the balance per bank statement, it's fair to say that the first item has already been adjusted for, right? It's not recorded in the cash book, correct? But it does show in the bank statement. You see the bank charges in the bank statement, right? The bank charges are already recorded in the bank statement. So in fact, we don't have to do anything with this $30. It's already included inside the 740. Now, the unpresented check, that's the one we need to adjust for. So we are working towards the cash book. Cash book is the point of view of the accountant. So as an accountant, I would deduct all unpresented checks. Right? Once I make a payment, I will deduct the unpresented check. So 740 minus 150, my balance as per adjusted cash book would be 590. Alright, so you don't adjust for the bank charges, don't deduct the 30, don't add a 30. It's already adjusted, it's already in the 740 balance. Let's move on to question 12. George is preparing his purchases ledger control account. Which information would he obtain from his general journal in order to do this? So you're preparing the purchases ledger control. Purchases ledger, we are looking at the payables. So which item from the general ledger are you going to make use of? A, contra entry with the sales ledger, right? So a contra is where you reduce the payables and receivables at the same time. So I owe you money, you owe me money. What we do is we are going to net things off, right? I owe you 700, you owe me 500. We're going to net it off. I pay you 200. So that is the contra. Contra does fall in the context of the general ledger, general journal, Alright, so A for now is a good answer, but I'm gonna check the rest just to be sure. Goods returned to credit suppliers. I will see this in the purchases returns account. Purchases returns journal, right? Doesn't fall within the general journal. Irrecoverable debts written off. So customer unable to pay, right? We write off their debt. This does appear in the general journal, right? But don't fall for the trick. You gotta be extra careful. What are you dealing with here? You're dealing with the purchases, right? The payables. You're not dealing with the receivables. So C would be out of your answer. Refunds received from supplier, so any money that comes in through the bank or cash, we're gonna park it under the cash book. So not within the means of a general journal. So I believe A should be our best option here. Question 13. Javed's sales ledger control account had a debit balance of $12,000, interest of $40 on an overdue account, and also discount allowed of $150 had been omitted. Right, so we forgot to add in the interest as well as the discount. So what was the correct balance on the sales ledger control? This is easy as 1, 2, 3, right? Sorry, it happens, you know. It's easy as 1, 2, 3. Okay, I'm not gonna sing here. I don't wanna get sued for copyright, and probably you don't want to listen to my voice. Okay, so let's look at the balance, right? Sales ledger control initially was at 12,000. There is an overdue interest, so this should increase the amount owed by the receivables. Discount allowed, right? We give a discount to our customers. This should reduce the amount they owe. So let's grab a calculator and gonna press some buttons to get to my answer of $11,890. That would be the final corrected balance on the sales ledger control. Question 14. What is the effect of incorrectly treating expenses as capital expenditure? Right? What is the effect? It's supposed to be an expense. We spent money on something, right? Supposed to be an expense, but we recorded this incorrectly as an asset, right? As a capital expenditure. So what happens here? Profit for the year. Since I did not record any expense, right? No expenses recorded. Yeah, incorrectly treating expenses as an asset, right? So no expenses recorded. My profit would be higher, would be overstated. Expense not recorded, so expense would be understated, and with that we derive B as our answer. Now for question 15. Atif depreciates his motor vehicles at a rate of 20% per annum using the reducing balance method. On 1st of May 2024, Atif owned motor vehicles which had cost $35,000. The accumulated depreciation on these motor vehicles was 12,600 on 1st of May 2024. So what will be the balance on Alif's accumulated depreciation account on 30th April 2025? Not a difficult calculation. In fact, this is a level 1 calculation. We just need to work out the depreciation for the year 2025 and add it into the opening accumulated depreciation. That's all, and you'll get your answer. So let's start by calculating depreciation. 35, you're going to take cost minus accumulated depreciation because we are using the reducing balance here. Now try to multiply by 20%. All right, let's press some buttons. What do you get? $4,480. All right, and from there you're gonna add this 4,480 to the initial 12,600. So you should be getting a balance of $17,080. Simple mathematics. Now let's move on to question 16. T Limited rents out part of its premises. At the start of the year, the tenant was $600 in arrears. During the year, T Limited received $8,650 in rent from the tenant. T Limited's income statement showed rent receivable for the year as $7,900. So what was the balance brought down on the rent receivable account at the start of the following year? So when you see something to do with accruals and prepayment, best to go with a ledger. Right? Best to go with a ledger unless you are really good in math. Then you go ahead and use mathematics. I have this kid in my class. He's Asian, obviously. He never uses any ledgers, never uses any calculators, and every time he gets the correct answer, the correct amount. I don't know how he does it. No, sometimes even I need a calculator for, complicated numbers. But this guy, he just does it. I don't know how. Wish I had his brains. Well, I mean, some people would say the same for me, right? Some people have said they want my brain. Unless I die, unless I become a zombie, unless you become a zombie, you're not gonna get my brain, okay? Zombie, okay. I gotta stop that. I gotta stop that. I can think of any song with any given word. I don't know if that's a good thing or a bad thing. Well, it's probably a bad thing because you probably guess my age from what I listen to. I'm not that young anymore. Can't lie. I'm not that young anymore. I'm already 18. I'm young. Okay, so rent receivable. Let's park in everything here. Rent in arrears. Now be careful. You are renting out. Yeah, I wanted to do this with a different color. You rent out part of your premise. Okay, you gotta be very careful with this question. It's a trick here. When you rent out part of your premise, this actually reflects rental income. So the 600 in arrears would be accrued income, right? Accrued income, you have the rights to receive it. It is an asset. 600 on the debit side. You receive rental, debit bank, credit rent receivable, 8,650. So income statement showed rent receivable 7,009. That is gonna be here. Alright, the income statement, you're gonna park it on the debit side because you'll bring it over to the credit later in the trial balance. So let's try to work out some figures here. Obviously, I think the credit side is still larger, 8,650. You only have 8,005 on your debit side. So there will be a balance carried down of 150, which you're gonna bring down to the next month on the credit side. So the balance brought down 150 on the credit side. Let's move on to question 17. A provision for doubtful debts of 5% of trade receivables is maintained. At 1st of January 2024, the provision for doubtful debts account had a credit balance of 240. At 31st December, trade receivables owed 5,002. It was decided that $200 of this amount was irrecoverable. Which entry was made in the provision for doubtful debts account on 31st December 2024? Again, involving some calculations, but it's very straightforward. It's a level 1 question. What we gotta do is we gotta find out the provision for the current year, and you're gonna compare that with the opening balance to look at the entry. So this year, receivables owing were 5,002. 200 is irrecoverable. So we're gonna take the 200 out of here because we're never gonna see that money back. So 5,000, all right, you're gonna multiply this by 5%. So that's for 5,000 by 5%, you're going to get 250. Now, this is your provision for this year. Last year, the opening balance was 240. So your provision for doubtful debts would increase by $10 in the year 2024. So to increase the provision for doubtful debt, you're going to credit $10 because the doubtful debt is a reduction to asset. So this year, the doubtful debt increased by 10. That means your receivables are going to reduce by a further $10. Let's turn you to question 18. How should a business value its inventory? Right, straightforward question. How do you value your inventory? So there is an accounting standard for this. I know you're not doing accounting standards in the IGCSE paper, but when you do go to ACCA, or you start doing a diploma, you will learn, okay, inventory is governed by IAS 2, International Accounting Standards 2, and this accounting standard specifically states that inventory is valued at the lower of cost and net realizable value. So the lower of cost and net realizable value, which is your selling price minus selling cost. Now, in case you're wondering why is it the lower of and not the higher of, right? You gotta refer back to the accounting principle of prudence. Prudence states that we should not right? Do not overstate assets. So we always go with the lower of. It's never at the higher of, and it's never book value. Book value only relates to non-current assets. Are we alright so far? So I think that's half of the paper done, right? Half of the paper is done. So I'm going to stop here at this question 18. We're going to continue the second half of the paper in another video. So feel free to take a break. Feel free to, just get some rest. And we'll see you in our next discussion video. If you'd like to see more discussion videos, let me know in the comments down below what you want me to discuss next. And yeah, make sure to like, share, and subscribe. I'll see you for part 2.